in my opinion, the really important thing is aiming for good unit economics, and then being very deliberate when you're investing in growth.
Immad, thank you so much for joining us. He's the founder and CEO of Mercury. Mercury is one of our headliner partners of all of our On Deck fellowships, and we highly recommend using them and using some of the kind of discount codes and perks that we have in partnership with them for your startup. So today we're going to talk about their new Treasury product and kind of Finance 101 for after you have already fundraised. But that's kind of all I have for my intro. You can totally take it away and tell us a little bit more.
Sure. I guess I'll give a little bit of context about myself. I've been doing startups since 2006, so Mercury is actually my fourth company. Throughout that time, I have failed to raise many a times and successfully raised many a times. So Mercury, we've raised seed round with Andreessen Horowitz and a Series A with CRV, and we've raised more than 25 million. So yeah, I wanted to touch on like whatever's interesting to everyone listening in terms of fundraising, budgeting, forecasting, all of that kind of stuff. Mercury Treasury is something we launched last week. It's basically a product to, if you've raised more than like 20 million, generally speaking, you don't just put your money in a bank account, you get access to kind of money market products and treasury bill products, which is something that like, generally you need like a CFO and that kind of thing to access, whereas Mercury with Mercury Treasury makes it accessible to anyone who's raised, or anyone in the On Deck community will be part of the Tea Room, so they'll be able to access it. And then you can kind of automatically make kind of smart decisions on like where your capital goes to once you've raised some money, and we've got some like pretty good kind of funds and options to give you some yield on any money raised. So yeah, I mean, I'm happy to kind of jump into whatever topic is interesting to the community though. Or I can just tell you a story if you want.
Let's start with just what are some of the first things founders should think about after raising that are in that financial category?
Yeah, everything starts from like, what are you going to do with the money and where do you want to get to? I think it's a good idea to kind of take a reset at that point and say, I think, generally speaking, we're talking about kind of, companies that are not profitable and not aiming to be profitable. So you kind of have to go from like this mindset of, okay, when am I going to raise my next round and what are the milestones I need to hit there? So yeah, if you've just raised a seed round, then you're kind of thinking about what's my Series A milestones. If you have no idea what a Series A milestone is, you should probably just like go talk to some VCs, and like normally, hopefully you've talked to some VCs as through the process. Maybe you have some VCs that are part of your network, or maybe some investors that were angel investors that are VCs, so you can get an idea of it. Every kind of industry has like separate milestones, but like, like in SaaS, maybe the milestone is try to get to 100K in MRR to get to a Series A. So once you worked out milestones, then you kind of think about your forecast. So how, what is realistic in terms of what you need to do in terms of hiring salespeople and all this kind of stuff to try to hit like these milestones. And then once you work that out, you can then try to think about what's my budget going to be to get not just to that milestone and be able to raise the next funding round, but ideally at least 6 months extra runway. So you want to plan it out so you can get to that milestone and have 6 months, and if you want to be conservative, maybe a year or more. So because, in startup world, you kind of want to always prepare for the downside scenario where you plan something out and you kind of, things don't go as well as you plan, there's issues with product, you don't close a big sale that you want. Yeah, all of this stuff kind of always happens. So you want to give yourself kind of an extra significant cushion. And then based on that, you do your budget, and like I kind of think about the budget as kind of like this worst case situation where you don't hit your revenue models as much as you want. If you're pre-revenue, then I would plan out the budget as if you're never going to make revenue. You don't want to have an optimistic budget. It's much better to have a pessimistic budget and beat it, and have, excess money on hand. No one ever complains about a little bit of excess money, but you will definitely complain if you run out of money. So that's kind of how I think about the budget. And it's not, I think the budgeting process is not like some crazy complicated thing. It's mostly, for most kind of software-based companies, the biggest cost is people. So you kind of want to factor in like, what are the rough kind of types of people you will hire, what kind of salaries will you require, where you're going to hire them, will obviously influence as well. If you've got like, an operation in another country, maybe you'll have cheaper kind of average salaries. So you kind of feel as much data as you have, put that in a budget, figure out how many you can hire. And just because you have space in the budget doesn't mean you have to hire. Like if you're at a stage where you're waiting for things or whatever, and you don't feel you're quite there, you don't have to hire just because you can't hire in the budget either. So yeah, that's how I think about it. That's super high level. I'm happy to kind of dive into any of those aspects.
Yeah, I'd love to hear kind of your opinion regarding hiring early. What do you think about hiring people who are earlier career but lower salary, as in like less experience, lower salary versus more experience, higher salary? How do you think about those trade-offs when it's your first handful of employees, like 10, 15?
I think at a startup, it's hard to hire super duper early. It's possible, but it's just like if they're literally just out of whatever university or boot camp or whatever it is, often at a startup, you don't have the resources necessary to kind of train them up and make sure they're like guided in the right path. On the other side, it's also often hard to hire someone with, 10 years of experience. Like they just tend to be quite expensive and have expectations. So I think somewhere in the middle is normally what I would choose. You might have like a few more experienced people that you have to give more equity to, and they're like, maybe they're not co-founders, but you kind of think of them as like, that's my founding team, and that's like a very incentivized person. And then you have kind of other people that are like, 2 to 4 years experience is good. I think a lot of the time, having kind of a lot of energy and like kind of raw skills and intelligence goes a long way, especially when when you're in the early stage of a startup. A lot of the problems are new, so sometimes experience can even be a negative because people are trying to apply their previous like solutions to your problem, whereas like actually like your particular way of doing sales or your particular way of doing marketing might be unique to your industry and your kind of idea. So it's nice to have like people that can be a little more flexible. So yeah, that's kind of the balance I think works. But yeah, I think everyone is different. I don't think there's like necessarily a formula. It also depends on the founding team, like what's their DNA, what's the type of person that they're drawn to, what's their network that they're drawn from. So a lot of the time, these kind of super early hires do come from the founding team's network.
Yeah, I had a question. Do you have any mental models or frameworks when thinking about growth versus profitability?
Yeah, that's a good question. I mean, again, there's not necessarily a right way to do it. I've always been a very like strong growth mindset kind of person. So, in my previous company, we did eventually hit profitability. But most of the time with Mercury and the previous company, we weren't necessarily like aiming for profitability. I think in my opinion, the really important thing is aiming for good unit economics. And then being very deliberate when you're investing in growth. So I don't personally like building a company where, I know the unit economics are bad. Like every user I'm buying is like costing me more than I'm going to get paid back in a year. Or like, I'm just like selling them a service that actually costs me more than it is to serve them. But if the unit economics are good, then it's a question about like, do I want to invest in the future versus, and investing in the future is like, kind of over hiring, or like, maybe it takes you 12 months or 24 months to get like full payback on users, so you might end up spending a lot of money this month, but you're not going to get paid back for a long time. There's a good model that Fred Wilson has. It's like, I can't remember what he calls it. It's like the 40% rule or something like that. But basically it's like you take your kind of growth and subtract your margin, and that should be 40%. So if you're growing 200%, then you can have a minus 160% kind of cost, if that makes sense. Like you can spend 160% more than your revenue. But if you're growing less than 40%, you should be, you should be spending like, you should be making 40% more than your than your costs are. I think that's like a good kind of mental framework. Like if you're growing fast, I mean, obviously like people at day zero are always going to have like near infinity growth, right? Like you just like started from zero. But once you're like 6 months in, hopefully you get like an understanding of that. So that's kind of one way to think about it. The other important thing is like to have a good, I know this isn't like quite binary and isn't always obvious, but I think it's if you have a good idea of like, have you hit product market fit yet? I think if you're pre-product market fit, you just want to be, if you don't quite have the product right, you don't want to be throwing like fire, like you don't want to be like increasing your burn and like trying to grow really hard. Like you need like a strong like base, and that strong base doesn't necessarily come from like more people and more costs. Like actually, I think less people, like, you know, a team of like 5 to 8 people are more likely to like be able to iterate and find product market fit than like a huge team, just because it's very hard to be kind of agile when you're a big team. So I would say if you don't have product market fit, like be a bit more conservative. I mean, there's not even a point necessarily to aiming for growth, apart from if it gives you like a better sense of whether you have product market fit yet. I think once you do have product market fit, I think it's a different equation where you can like, okay, you know, then it's like, how do I press kind of feel on this like thing that's working?
Got it. Thank you. That was great.
We definitely want this to be really interactive, so please don't be shy about asking your questions. And there's no dumb questions, nothing that's too early or too simple. That's what we're here for.
Hi, Immad. Thank you for helping us here. Question, I know it varies by company, but typically, how many months of runway should we be thinking in terms of seed, let's say, from seed to Series A? Yeah, thank you.
I mean, I would say 18 months is kind of like the minimum you should be thinking. Ideally, 2 years. The bit that it depends on is like how hard is it for you to hit the milestones and like how complicated your company is. So, you know, when we were starting Mercury, it's like a fintech company, especially back in 2017, just getting from like 0 to 1 in like, you know, building a challenger bank had a lot of uncertainties, and there was a lot of kind of working with these kind of old school banks and things like that, which can take much longer. So I factored in 3 years in my kind of initial runway plan. But I think if you're building like a pure SaaS business, then, you know, I think 18 months on the low side. I would say the other factor is also if you happen to overraise, like something that happens, you know, relatively often actually, is you plan to raise 2 million, but like you get more subscription, maybe your valuation goes up a little bit and you end up raising 3 million. I don't think just because you raise 3 million doesn't mean you suddenly spend like an extra 50%. You should just consider having an extra 1 year runway. You know, more money isn't necessarily like solving your problems quicker. So I think one mistake that people do is they overraise, they spend a lot more money, and then they get at the end of it and they haven't made as much progress as they would like. So there's actually nothing wrong with overraising if you actually spend less money. But so that's one caveat to it. But yeah, I would say 18 months is like complete minimum. Some people do raise for 12 months, but 12 months is brutal because you're basically back at fundraising after 6 months, which, you know, it's like how much progress have you made in that 6 months? So yeah, 18 months, ideally 2 years. Yeah, generally speaking, having a nice buffer is useful.
And around kind of the like fundraising tips and advice, now that everybody's been raising over Zoom for coming up on a year and a few months, what do you think is different from fundraising now versus before?
I think seed funding is actually just generally better. It's easier and there's more people available. So I don't think, you know, even if maybe, you know, early next year it's a little easier to fly because the people have vaccines or whatever, I think most fundraising for the seed stage will still be happening over Zoom, which is generally better for founders, right? Like you don't have to fly around, you don't have to drive around, whatever it is to meet investors. You have a wider pool of investors available to you. I think the other thing that at least seems like it's changed a little bit, and maybe this is to some extent VC's virtue signaling, but it feels like it's a little easier to get to people without without intros. I think Twitter DMs are like probably the best way to kind of get to an investor and get in front of them and not have to like chase an intro and how to do it. I think it's still better if you can get a warm intro to an investor. But I feel like in 2020 now that like things are going more virtual and there's a lot more kind of emerging angel investors, like I think people are a lot more open to that kind of just a cold intro and getting started. We also have this program called Mercury Raise, which we're going to run again in January, which is this thing we run for free just to help kind of our customers and just general people help get funding. So if that time lines up with your kind of timing in January, feel free to apply for that as well.
Can you tell us a little bit more about it? Don't worry about it sounding like an ad. I think that we all want to understand more about what Mercury is offering to us. That's why we're here on the call.
Yeah, I mean, we're doing it for free, so it's not like there's no reason for me to kind of promote it beyond helping people. It's just mercury.com/raise. We have a lot of kind of early stage companies, so and people often ask us about fundraising, so we just kind of made a program where you can, we ask a few questions, you apply for it, and then we send it out to a network of about 180 investors we have that are pretty much some of the best investors at seed stage. And next time, we haven't announced this, but in the next batch, we're going to do some more curation as well, so we can hopefully get kind of more signal to these investors and get them even more interested. But we've run it once before, and it was a pretty successful program. But yeah, so I think that's the biggest thing. I think cold intros are easier. I think, but it's still not easy to fundraise. Like I think sometimes people think it's easy and like they don't give it the respect it deserves. So I would say, you still want to like work your ass off when you're fundraising and make sure like your pitch is really good and you run like a really, not a huge pipeline, but a very reasonable pipeline, and work very hard towards like getting a close done quickly.
Totally. Nico, do you want to ask your question out loud?
Sure. So, with the proliferation of a lot of different funds that are really tailored for the earliest stages within a company, you might assume that some companies are actually getting to the A, or at least theoretically trying to get to the A, having sold 40% or so, give or take, right, of the company before they even reach that. Now, traditionally, that's been a red flag at the A for obvious reasons. But I just wonder, with so much early stage cash floating around, has the thesis around how much should be sold before the A, is that starting to evolve too, with pre-seed and accelerator cash being so flush these days?
Yeah, I mean, one thing that's like kind of at play is that these names are changing, but the names have stayed the same, but the actual round is like completely different. So for example, when I did my seed round, this price seed round, it was a 2 million valuation. This was my 2009 seed round, whereas like 2 million is now like super pre-seed, right? And like now A's are like between 10 and 15, which would have been a Series B like 8 years ago. So I think one aspect of this is that actually like pre-seed is really the seed, and seed is kind of like the A, and like A is kind of like the B. So that's partly why I think companies are coming, have raised subsequent rounds and like are coming more diluted. I think 40% given to investors by Series A, it's not a red flag. I think above 50% it gets into the red flag territory, and I have seen that happen. But it does happen nowadays. Some people do like accelerator, seed extension, and that stuff is brutal. I mean, as a founder, like you should try to avoid it. I think if there's, coming back to my previous point, like if you raise too much money and any money comes with more dilution, you should just like try to not burn it as highly, so you get a longer runway, so you don't have to do a seed extension and all that kind of stuff. So yeah, it is a reality with a lot of companies. At the end of the day, these kind of cap table red flags, they're actually like relatively late in the stage. By the time, unless it's super bad, most Series A investors won't like not do it. Because you've already pitched them, they've already like got fairly committed to it. Now they're doing due diligence and they're looking at the cap table, and then they're like, oh, this isn't good. If it's that bad, like if you've gone above 50, there's this whole process called a recap, where you can basically like, reissue extra founder shares, to get you back to like a reasonable level, or you can kind of, there's all sorts of shenanigans you can do with your existing cap table to kind of reduce how much shares they have. So yeah, if it gets really bad and the Series A investor actually wants to do it, then yeah, this between the founders and the new money in the Series A investors, you actually have like a reasonable amount of leverage that you can like hopefully push like some of those older investors to get like slightly less shares. It does get like messy, but I've seen that happen too. And yeah, sometimes like if you've been at it for like 5 years and you've done a pivot and then you've had to do all this stuff, you can be at like kind of a major disadvantage by the time you get to your Series A. So it can be like pretty reasonable to push for some sort of recap.
Thank you.
Happy customer here too, Immad. Thank you.
Awesome. Thanks, Nika.
Nice. Arthur, want to ask yours?
Sure. Yeah, thanks for coming on. But just curious to hear, I guess, two things. One, for a pre-seed round or like a seed round, how many investors do you kind of consider putting in your pipeline? And then love to hear kind of the story behind you raising your first pre-seed and seed rounds, depending on what the name is.
I think the answer to the pipeline is like, it should probably be uncomfortably large at a seed round. Like we're talking about at the top of the funnel, maybe 200 people. I mean, basically, like this should be your life for like 3 weeks. How many? If you're gonna do only one thing and you're gonna work like your absolute ass off on it, like how many people can you contact? Also, I mean, it depends also like how good is your network, right? Like you don't necessarily need 200 people at the top of the pipeline if every person you email is going to respond to your email, right? Like if you can have like a very high conversion rate, maybe you can get away with 50 initially, and then you can fork off there. The other aspect is, you want to work your network a lot. So yeah, if an investor does come in, you want them to go, okay, who are your 10 favorite investors that you can introduce me to? You also want to kind of bug all your friends that are entrepreneurs that have raised money to say, who are your favorite 10 investors? Like if you bug everyone and try to get 10 leads out of them, it doesn't take much. Like even if you start with 10 people initially, you can have 100 people after that, right? So it doesn't make. And nowadays there's so many seed investors out there, right? Like there's angel investors doing their own money. There's like kind of syndicates and rolling funds and all that. There's all these VCs, but the seed fund people, and then the bigger VCs that do seed stage. So I think the market is huge, and you should definitely be able to get to like 200 if you work hard. Walk us through your first, it's a bit like my first ever, I guess, like seed stage stuff was, 2009. I don't know if there's like great lessons to be had there in terms of like walking you through my kind of round. And then my most recent seed round was with, Mercury, which was in 2017. But, by then I had like most of the initial kind of set of investors were all like kind of friends of mine and within the network. And then we managed to get kind of Andreessen Horowitz as a lead. So I don't know if either of those have like some kind of meaningful lessons. I would say for my, round that I did in 2009, we work really hard. Like it was like whole kind of funnel of like all these investors. And 2009 was a brutal time to fundraise as well, right? This is like straight after the recession. I think only maybe like 3 companies in our YC batch got invested, like us, Airbnb, and the one called Cloudant. So it was a really bad time. That's out of like 20 companies. So yeah, nowadays life is like much easier for entrepreneurs, which is good. But these markets are bigger as well, which is also good.
Awesome. Alicia.
Hey, yeah. So was curious on your thoughts on party rounds and accepting really small checks. I've seen some threads on Twitter, for example, of some folks even creating their own sort of angel syndicate to accept small checks from angels in the beginning of seed rounds. Just curious to hear your thoughts or any past experiences with that sort of thing.
Yeah. I mean, I would say initially, don't complicate your life, right? Just if you've got, even if it's a small check of 10K, assuming the investor's good and you want them, just take the money and do a safe and get on with it. I think party rounds are fine personally, as long as all the investors are real like startup investors and they understand that they could lose their money, and they understand that they sometimes need to like send a signature quickly and they're easily available over email and all of these kind of things that a modern kind of startup investor would get, but maybe like an old school kind of non-startup investor won't understand. I think it's fine to have like 20, 30 people in. What happens, which is like, I think what you're referring to with Twitter stuff, is sometimes you have a really hot company, and companies that are completely normal can become hot later. And then for whatever reason, that entrepreneur wants to have like 50 other angel investors involved. So like, Clubhouse, actually don't even know how many angel investors they had, but probably like 100 angel investors or something like that. But obviously it's a hot company, Andreessen did the rounds. They could have got probably 1,000 angel investors if they really wanted. In that kind of scenario where you're like hot, you want to, you've got the time and the ability to collect like a lot of angel investors and the willingness to do it. At that point, you can set up SPVs, and AngelList is the most kind of popular platform for that. But I think there's a few other ones as well. And then it makes sense, right? The benefit of like doing it with an SPV is there's one signature, one entry on the cap table. You can get things moving quickly and all that kind of stuff. But I wouldn't like start off like complicating life there. I think from my perspective, the best kind of party rounds are those kind of party rounds where you have one lead investor that really takes at least half the round, that really cares about your company and takes like significant ownership in it. It doesn't have to be like a Series A VC like Andreessen Horowitz, but there's lots of kind of seed funds right now. So you do that, and they're like your significant holder. And they're the ones that you're going to hopefully call once a month and have a real kind of relationship with. And then you have a bunch of other people who, maybe 20, maybe more, that can just be like these ongoing supporters of the company. So Mercury has altogether about 100 investors, and it's just like, it's just fun. Like when I send an investor update, at least one person among 100 will be able to help with almost everything I ask for in there. Which is, I think entrepreneurship is kind of a pain in the ass. So it's nice having like a pretty large kind of set of kind of people that can be supportive of you. That's kind of how I think about party rounds. But some people are like, oh, there's too many people in the cap table or too small checks. I don't think, as long as the investor is strong and they're going to help you, often the most helpful people are the ones with the smallest amount of money in the cap table, just because like, they're not very rich, they're very like hungry, and they're willing to like work hard for their money.
Makes a lot of sense. Thank you so much.
Yeah, I'd love to double click more on the investor updates portion that you're discussing just with this question. How would you go about structuring just sending those out, and like what kind of asks would you put in there? Because you mentioned that some of those people who were who had smaller checks and kind of had more time, they were willing to go to helping out with those asks. So I'd love to hear more about structuring those investor updates.
Sure, I've got a good tweet about it. I should really collect my tweets together in a useful format. But I like making like very informative investor updates. I do them every 2 months or so. I share them with the whole company. How I do it is like I have a section for like KPIs where I have some graphs, and then I have like a table of like last 4 months of KPIs and like their growth rates. And I think the key KPI in there is like revenue. I think sometimes people don't include revenue, but I think they should always try to include revenue if they have some. So that's step one. And then step two is that I have a pretty honest kind of discussion on like what are things going right and things going wrong. And I try to put like 3 things in both of those, and that's almost always at least 3 things going right and 3 things going wrong. And then I talk about like what's the plan for the next 2 months, like plan in terms of what I want to hit for the next investor update. And I also compare it against my plan for the last investor update. So that's kind of the core of the investor update. And then in terms of asks, I think the 2 most generic asks that you can always ask people is like, can you introduce me to X? So if you have some sales or things like that, that's always a good one to, and like I try to make them like fairly specific rather than like, can you introduce me to any Series A company? I'll say like, can you introduce me to like this or this company kind of thing. So it's easy for people to, fulfill the asks. And then the other one is around hiring. I'm looking for an engineer. Engineers, to be honest, it's rare to get like investors introducing you to engineers because everyone's asking that. But if you have like slightly more specific things that are useful for your industry, that tends to be fairly useful. And the other one is just like, asking for people's opinions, like, oh, what do you think of like this kind of thing? And you can get like sometimes like pretty interesting kind of discussions going. Ideally, everyone you have in your investor list is like someone you would love to hear from, because like they're all like smart people and you value their opinion. So yeah, that's kind of how I structure it.
No, that was great. Thank you so much. And I will look at that tweet storm.
Yeah, it's in there now.
Awesome. Yeah, I linked it in the chat. Taylor, want to ask a question?
Sure. Thank you. So you mentioned this, I think, very briefly at the beginning with respect to companies that have like 20+ million in the bank, and like, it's standard for them to take some of that money and invest it, elsewhere other than it just sitting in the bank. Can you talk about companies that are in the sub 1 million in the bank stage? How should they be thinking about what to do with the money? Like for, obviously, keep some in the bank or all of it in the bank maybe, but like the stock market is ripping, Bitcoin is ripping. Like, are these things that we should be considering at all?
I mean, I know I see Akram's got this Bitcoin logo behind him, so he might get offended by my answer. But I would say in general, like, you've got your money to build a startup. You don't want to do anything that has at all any risk to it. Stock market's ripping right now, but there's nothing stopping it going down by 30% like it did in March. And you don't want to go, oh shit, I raised $1 million, but now I have 700,000 left. And Bitcoin's gone down by 4x in 2017. So yeah, it's just not worth putting in anything volatile like that. So as part of Mercury Treasury, we picked out kind of 2 funds. One has got slightly more yield, but it's only 0.18% right now. And that's just because like that's the best you can get in the market without like taking any risk or very, very minimal risk. It's not, the yields aren't crazy, but that's just the way the market is right now. I wouldn't do anything. Bitcoin, stock market, all of that. Like, I mean, you can put like a bit of play money in there if you really want. And there's some situations like if you're doing a crypto startup, you need to hold like some crypto anyway, then it might be like more aligned with the strategy. But in a normal kind of startup, I wouldn't take any risk with the
just a quick follow-up question. At what stage should a company start thinking about investing their treasury outside of just a bank account?
Well, I mean, with Mercury Treasury, you can do it basically at, not day 0, but as soon as you get funding, and it's all kind of built into it and easy to use. So yeah, I think you can do it there. Anything like more complicated than like a very kind of built-in, easy kind of money market product, I wouldn't think about until you've raised more than 50 million, basically.
Okay, got it.
And this situation might change a little bit if the Fed rate changes and the yields actually go up, and there's like maybe a way to optimize it better. But Mercury Treasury is set up to go up, with the market, like it just tracks the market. So we want to give you the best rate we can.
Awesome. You touched on this a little bit before, but how do you think about raising from rolling funds versus direct angel investors versus institutional investors? How would your approach change? Do you like line them up at different times in your process, anything else like that?
Yeah, I don't think rolling funds and seed funds are that different. I think the big difference is like, is it a solo GP versus like a firm with like 5 GPs? There's definitely like a significant difference between like, if you have to talk to one person and they have to kind of make a decision, it tends to be quicker. There's less like complicated due diligence involved. The checks tend to be like smaller, but that's kind of like, there's a whole class of kind of these solo fund managers where most rolling funds are in that class. And those are definitely, just easier to get done. Just because it's that one person and they're making a kind of a non-committee based decision. And then the seed funds and VCs. So the thing that's similar about them is they generally want to like lead the round, and they want to have like significant ownership as part of the lead. And because of that, you don't want to talk to them too early in your process. Like you don't want to talk to them at like the first people you want to talk to. You want to have like, easier people that you can quickly like start building a momentum from. But you don't want to wait too late in the process either, because if you've already, if you're raising $1 million and you've already done 600K, then it's going to be very hard for them to get the ownership they need without like diluting you a lot. So you kind of want to target to talk to them in the middle of the process. They also just take longer. They'll take minimum 2 weeks normally because you have to talk to one GP and then another, and then there's sometimes a full partners meeting. Even when they're like pretty interested, the process can drag on for like 2-3 weeks pretty easily. When it comes to institutional like investors that are normally Series A investors, I would say, under some circumstances, you should talk to them. Like if you're doing a seed round and you have a lot of momentum, or, you happen to come from a place where you worked at Coinbase or something, like you have like some credibility and you can like kind of approach the Series A VCs. Otherwise, I think Series A VCs on the whole tend to be a waste of time for seed stage companies. They tend to always take the meeting, which like makes you get all excited about it, but then you end up spending like all of these cycles talking to them, and then that's just their job to do meetings. So it tends to be, in my opinion, a waste of time. But anyway, if you happen to be in an exciting sector or something like that, and you have a lot of like interest from Series A VCs, I think the big thing from my perspective is like, I think it's always important to give a Series A VC like at least 10% of the round. Like you want them to have 10% ownership in your company by the end of the seed round. That way, there's this whole like process. I don't want to confuse it too much. I guess I have to talk about it now, but there's this thing called signaling risk. Basically, like if your Series A investor does like a small check, they put 100K in your seed round, they don't really have that much ownership. What they're really doing is they're buying the option to look at your Series A round before anyone else does. And if they do look at your Series A round and they're not interested, maybe the partner that did the seed has gone, and like there's, there is like reasonable changeover at these companies, or maybe they've just kind of moved on and they're thinking about other things. It can be like your company can be perfectly fine, but you've got this like kind of red mark on your company before you've even got to your Series A, where one of your seed investors that has a well-known reputation to do Series A's is refusing to do your Series A. And I've definitely come across companies that I've invested in even that have like really struggled with Series A's because their seed Series A investors refusing to kind of lead the Series A round. Sometimes it can work out fine, like you're particularly hard and the Series A investor does want to lead it, and then you've got this extra kind of tailwind behind you to push your Series A. But yeah, sometimes it can be a bit of a disaster. So anyway, in conclusion, I think if you're going to have a Series A VC, you want them to have at least 10% ownership in your company. And it's also that's when they're going to actually help you, right? Like if they have some tiny stake, if it's like $1 billion fund and they've given you 200K, they basically don't give a shit about you. But if they own 10% of the company, that's when they're actually going to care and help you, which is like the whole point of getting a Series A VC in your round.
I mean, every time we're raising safes, there still is an implicit valuation when we're talking about what the cap is on that safe. So I'm curious, have you seen a rise in uncapped safes over the past few quarters as the market is starting to steady itself again?
I think the market for uncapped safe is like completely collapsed. I have so rarely see uncapped safes now. I feel like maybe. I mean, this is really this is going back a bit. Like 2015 was probably peak uncapped safes. I just don't see them ever anymore. What tends to happen now is people just come up with like some insane valuation. Like it's like a seed company. They've got like maybe 10K MRR and they're doing it like a 50 million cap. Or there's been a few pre-seed companies I've seen at 100 million. So like that's the insane valuation is the new uncapped, but no one's doing uncapped anymore as far as I see. I mean, I'm sure there's some exceptions, but there's just like, it's almost seen as like offensive to investors when you say uncapped nowadays.
So 50 million seems exciting, but it seems disrespectful to have an uncapped.
Well, the problem with uncapped is like, and then you're asking investor to bet on you now, but at the valuation that you're going to get in 2 years' time. So like the more successful you are, the worse the investor's like decision is. Yeah, it's just like logically it doesn't make sense. Whereas even at 50 million, you're like, hey, if I really kill it, I'm going to be at 100 mil. So at least I can 2x in the upside scenario. So that's like the perception difference. I mean, the only people doing like 100 million are like, you know, people who've done like unicorns in the past and things like that. That's not common, obviously.
Awesome. Well, thank you so much for joining us, Immad. This was very enlightening and helpful. I'm sure it was for everyone. Thanks everyone for joining, and thank you again, Immad, for your time.
Good seeing everyone.
Thanks,
Bye.
everyone.
Bye, everyone.